Imagine logging into your brokerage account, pulling up a stock you own, and realizing the company is paying out nearly 4 times more cash to shareholders than it actually earns on paper.
Yeah, that's a tough pill to swallow for a lot of people.
Right. I mean, for most traditional businesses, a payout ratio like that is a massive red flag. It's just a one-way ticket to insolvency.
Oh, absolutely.
But what if I told you that for one specific company in the energy sector, that terrifying metric might just be like their secret sauce? Welcome to the Byte-Size Brief. Today, we are putting USA Compression Partners LP, that's USAC, completely under the microscope. Let's get into it.
It really is an absolute masterclass in why you can never just glance at surface-level financial ratios and think you have the whole story. You really have to dig into the mechanics.
You really do. So if you've been watching the energy infrastructure space over the last few years, USAC has probably crossed your radar. Today is April 27, 2026, and their 5-year total shareholder return is sitting at an absolutely incredible 183%.
Yeah, that's a massive number.
It's huge. And right now, shares are trading right around that $26.86 to $27.69 range. Honestly, if you are a retail investor looking for yield, that chart is just a beauty to look at.
Well, the historical performance is certainly compelling, sure. But, a stock chart only tells you where a company has been, never where it's going next. We have to look at the underlying machinery both literally and financially.
And that is exactly the core mission of today's deep dive. We're going to unpack whether USAC's underlying fundamentals and this massive new acquisition they just pulled off actually justify their current valuation and that massive dividend yield.
Right.
Or are there hidden risks like supply chain bottlenecks and share dilution that everyday retail investors are just completely missing right now?
To accurately evaluate that share price and the future cash flow estimates, we have to start by analyzing the massive structural shift USAC executed at the very beginning of 2026.
A big deal.
Exactly. Everything changes with the JW Power Company mega deal.
Right. Let's talk about January 12, 2026. So USAC closed an $860 million acquisition of JW Power Company. That's nearly $1 billion.
A staggering amount of capital.
It is. And I was looking through their previous filings, and this isn't just bolting on a small competitor. This looks like a complete reshaping of their footprint. What exactly does $860 million buy you in the compression industry today?
Well, it buys you sheer density and dominance, specifically in the Permian Basin.
Okay.
To give you the exact figures, the JW Power deal brought 1.7 million active horsepower into the USAC fleet.
Wow, 1.7 million.
Right, which brings their total fleet scale up to roughly 3.9 million horsepower. In this industry, scale is everything because it allows you to dilute your fixed operating costs over a much wider base of revenue-generating assets.
Okay, so they just drastically increased their active footprint. But what caught my eye in the footnotes of the deal is that they also picked up a bunch of idle equipment, like about 200,000 idle horsepower.
Yeah, that's a very important detail.
Because as an investor, idle equipment usually sounds like dead weight, right? It's machinery sitting in a yard not making any money. Why is that a positive for USAC?
You have to look at the capital expenditure requirements to reactivate that equipment. Management specifically noted that roughly 50,000 of that idle horsepower is readily deployable.
Readily deployable means...
Meaning it requires very minimal capital expenditure to get it back into the field.
Ah, I see. So it's not dead weight, it's standby capacity. They don't have to build a new engine from scratch. They can just dust off that 50,000 horsepower, do some basic maintenance, turn it back on, and start generating immediate cash flow while they figure out whether to, redeploy, sell, or scrap the remaining 150,000 idle horsepower.
That is the strategic value, yes. And it ties directly into the valuation debate happening around the stock right now.
Right, the fair value estimates.
Yeah, if you look at the data we have from Simply Wallcent, there's a distinct divide in how the market is pricing USAC. The popular, more optimistic narrative points to a $29 fair value, which would imply the stock is currently about 7.4% undervalued.
And I can see why the market might lean that way. Like, USAC is seeing incredibly high contract renewal rates, and they are actively shifting toward longer-term agreements, especially in the high-growth Northeast and the dry gas basins.
Yes, the dry gas basins are a strong catalyst.
Right. And if I'm an investor, a longer-term contract means I don't have to worry about revenue falling off a cliff next quarter. It gives me earnings visibility.
That visibility is crucial for a yield-focused company. But we do have to balance that $29 target against the discounted cash flow model.
The DCF.
The DCF paints a noticeably more conservative picture, pointing to a fair value of $26.79.
Which is almost exactly where we're trading right now. So the DCF is essentially flashing a yellow light saying, hey, hold on, all this massive upside from the JW Power acquisition, it's already fully baked into the current stock price.
Exactly. The DCF model is inherently more cautious because it heavily discounts future cash flows based on potential drags, specifically the higher capital requirements and operating costs needed to integrate an $860 million acquisition.
Right. It's not free.
No, it's not. It challenges the assumption that bigger automatically means more profitable.
Okay, let's test that assumption. Because USAC currently has a fleet utilization rate of 94.5%. That is a staggering number.
It is extremely high for heavy machinery.
But I keep coming back to a real-world analogy to understand if that actually matters. Let's say you own a hotel, and it is 94.5% booked every single night of the year.
Sounds like a great hotel.
It sounds great. But if your hotel is essentially fully booked, you shouldn't just be patting yourself on the back. You should be jacking up the room rates.
Absolutely.
Because if you aren't raising prices when demand is that high, you are just running your hotel rooms into the ground for a flat fee. Are we seeing actual pricing power here from USAC, or are they just running these compressor engines at max capacity without capturing more margin?
Well, if we look at the quarter-over-quarter data, the numbers clearly show they are exercising pricing power. In the fourth quarter of 2025, leading right up to this acquisition, USAC's average pricing hit an all-time high of $21.69 per horsepower.
All-time high. Okay, so they are fully booked, and they are successfully charging more per unit.
Yes. That $21.69 represents a 1% sequential increase from the third quarter and a solid 4% increase year over year.
Nice.
So they are successfully passing along price increases to their customers while simultaneously maintaining that massive 94.5% utilization rate.
That is exactly what you want to see as a shareholder. And on top of raising the rates, they are still adding more capacity, right? Active horsepower increased by roughly 21,000 sequentially from Q3 to Q4.
It did, yes.
But adding all this equipment and buying JW Power has to take a toll on the balance sheet. I mean, buying a company for almost $1 billion usually means taking out a massive mortgage. Where does their debt stand?
Leverage is definitely a metric to monitor closely.
Yeah.
At the end of the year, their leverage ratio sat at 4.0x. However, management is actively targeting a reduction. They want to bring that down to 3.75x debt to EBITDA over the next 12 months.
How do they plan to pull that off while absorbing such a huge acquisition?
Partially through strategic refinancing. They recently refinanced their credit facilities, which successfully dropped their weighted average borrowing cost by about 50 basis points.
Okay, let's unpack that 50 basis points for a second, because financial jargon can obscure the real-world impact. 50 basis points is half of 1%.
Right.
And when you are carrying the kind of massive debt load that a midstream infrastructure company carries, shaving 0.5% off your interest rate frees up millions of dollars in cold, hard cash every single year.
It really does. It adds up fast.
That is cash that goes straight to the bottom line, straight to securing the dividend, and straight to paying down the principal faster.
It creates a tremendous amount of financial breathing room, which they're going to need based on their forward guidance. Let's look at the actual projections.
Let's hear them.
In 2025, USAC reported a record full-year adjusted EBITDA of $613.8 million.
A phenomenal year by any metric. But their 2026 guidance is what made me do a double take. They're projecting between $770 million and $800 million in adjusted EBITDA for 2026.
It's a huge jump.
Right. I mean, Q4 was a steady, methodical climb, but jumping from $613 million to potentially $800 million.
Okay, so compared to last quarter, what actually moved the needle here? Is 2026 projected to be a rocket ship purely because they bolted on a full year of those JW Power assets?
The JW Power integration is absolutely the primary catalyst for that massive top-line jump. You are absorbing an established cash-flowing business, but it's critical to understand that this projected revenue growth is not free.
What do you mean?
Reaching that $800 million upper bound requires intense capital investment. Management has budgeted between $230 million and $250 million in expansion capital expenditures for 2026 alone. Wait, hold on. $250 million just in expansion capex? I was looking at their fleet size, and that seems disproportionately high if they are just trying to buy a few new units. Where exactly is all that money going? Are they bleeding cash into maintaining the older machines they just bought?
No, a large portion is dedicated to fleet expansion. They plan to add about 105,000 new horsepower in 2026. But a significant chunk of that $250 million is allocated to upgrading the existing fleet with advanced telemetry and panel upgrades.
Telemetry, you mean like remote monitoring software?
It goes far beyond simple monitoring. Think about the physical reality of the Permian Basin.
It's huge and
It is vast, harsh, and geographically dispersed. Without telemetry, if a compressor unit goes down, a company has to pay a highly skilled technician to drive a heavy-duty truck 3 or 4 hours on dirt roads just to diagnose the problem.
Ouch.
Right. And they might arrive and realize they need a specific filter or valve that they didn't bring.
So they have to drive all the way back to the depot. That is wasted fuel, wasted mechanic overtime, and most importantly, hours of lost revenue because the machine is offline.
Exactly. With the new telemetry investments, the central office has real-time granular data on every engine parameter.
Oh, wow.
When a unit faults, the technician knows exactly which valve is stuck or which pressure gauge is failing before they ever turn the key in their ignition. They pack the exact right parts. It drastically reduces downtime and fundamentally lowers the long-term operating costs of the fleet.
I love that. Spending $250 million up front hurts. But if it structuralizes efficiency for the next decade, that is smart capital allocation.
It's a necessary evolution.
But hitting that massive 2026 growth target and adding that 105,000 new horsepower requires actual physical machinery. And that leads us to a critical operational bottleneck happening in the real world right now.
It's a severe macroeconomic headwind. The lead times for securing new equipment, specifically the massive Caterpillar engines that exceed 2,500 horsepower, has stretched well beyond 2 years.
That's insane.
We are looking at over 120 weeks from the moment you place an order to the moment that engine is delivered.
Over 2 years. In a fast-moving energy market, a 2-year wait list is basically an eternity. If oil prices spike next month, USAC can't just order more capacity to capture the boom.
And the primary driver of this shortage isn't even coming from the oil and gas sector. It's driven by the artificial intelligence and data center boom.
Okay, stop right there, because this is where a lot of investors get confused. What on earth does a tech company building a data center in Virginia have to do with USAC compressing natural gas in Texas? What is the actual mechanical overlap here?
Well, data centers require massive, uninterrupted baseload power. The traditional power grid often cannot supply enough electricity fast enough to support these massive new server farms.
So they build their own.
Exactly. Data center operators are building their own off-grid power generation. To do that, they are buying up heavy-duty, natural gas-fired generator sets.
Oh, I see where this is going.
The underlying engine blocks inside those generators are the exact same heavy-duty Caterpillar engines that the compression industry uses to drive their pipeline compressors. They are literally competing for the same constrained factory lines at Caterpillar.
Right, but what does all that actually mean for USAC investors? I get that data centers are eating the world's power supply, but if USC can't get engines, doesn't their growth stall out completely? How do you add 105,000 new horsepower this year if you are stuck in a 2-year line behind Amazon and Google?
This is where the strategic brilliance of the JW Power acquisition really shines. It didn't just provide USAC with more horsepower, it provided a distinct structural moat.
Okay.
JW Power operated its own in-house manufacturing and packaging business.
Wait, so instead of waiting on a third-party packager, USAC can just build their own equipment now?
Yes. They internalized a critical segment of their supply chain. During their earnings call, management noted that the capacity of this newly acquired manufacturing arm aligns almost perfectly with their expected growth trajectory over the next couple of years.
That is massive.
It is. It allows them to execute their plan to add that 105,000 horsepower, which equates to about a 2% fleet expansion, without being entirely paralyzed by external supply shocks.
That is an unbelievable competitive advantage. While their smaller competitors are stuck twiddling their thumbs on a 120-week waitlist at Caterpillar, USAC is quietly assembling their own packages in-house.
It offers massive strategic optionality. In fact, USAC already has about 10,000 horsepower contracted specifically for their own internal manufacturing capacity in 2027. It fundamentally insulates them from the worst of the macro supply chain crisis.
Okay, I have to admit, I am feeling incredibly bullish on the operational side. They have fully booked fleets, they are raising prices, they are heavily investing in remote tech, and they can build their own engines. But we have to pivot and talk about the financial risks.
We absolutely do.
Because while USAC might be navigating the physical supply chain beautifully, there is some serious financial engineering behind this stock that every retail investor needs to understand.
It's essential to balance the operational enthusiasm with financial reality. The integration of JW Power is not going to be entirely seamless, and we need to start with the impact on their margins.
Lay it on me.
Management was very transparent on the recent call, explicitly warning that integrating the JW assets will actually drag down their aggregate gross margins in the near term.
But why? If you merge two profitable companies, shouldn't economies of scale make the margins better immediately?
In theory, yes. In reality, merging fleets is incredibly messy.
Like physically messy.
Logistically messy. You're dealing with duplicate routing.
Yeah.
You might have two mechanic trucks driving past each other to service different wells simply because they belong to different legacy dispatch systems. You are dealing with incompatible software and disparate inventory systems.
Oh, that makes sense.
You have to spend money to standardize parts so that a technician's truck is stocked correctly for both legacy USC engines and the new JW machines.
So it costs money up front to create the efficiency that saves money later.
Precisely. Management anticipates achieving annual run rate synergies of $10 million to $20 million, which will eventually improve their operating margins and reduce general and administrative expenses.
Eventually.
Yes. They were very clear. Those synergies will take time to realize. They will not fully materialize until 2027.
So 2026 is going to be a messy transition year on the income statement as they digest this massive meal. And we're already seeing the institutional analysts react to that, right? Zacks Research recently slashed their Q1 2026 earnings per share estimate all the way down to $0.40. They are maintaining a strict hold rating. S&P Global Ratings also just stepped in and revised their outlook on USAC from positive down to stable, pointing directly to slowing growth and expectations that leverage will stay above 4.0 this year.
The analyst community is pricing in the friction of the integration.
Which is fair. But let's move to the real elephant in the room, the dividend. This is why most retail investors are here. USAC boasts a massive forward dividend yield of around 9.3%.
The very attractive yield.
Very attractive. They are paying out 0.525 cents per quarter, which comes out to $2.10 annualized. If you are an income investor, 9.3% is incredibly juicy. But I started digging into their financial filings, and the payout ratio based on GAAP earnings is 375%.
It is a jarring figure for anyone trained in traditional corporate finance.
Jarring. I think it's terrifying. Let me use an analogy. Paying out 375% of your earnings to shareholders feels exactly like paying your mortgage with a high-interest credit card. How does a company survive paying out almost 4 times what it actually earns on paper? How is that dividend safe?
That reaction is incredibly common, and it highlights why you cannot analyze a master limited partnership, or MLP, using the exact same metrics you would use for a tech stock or a consumer brand.
Okay.
You have to look past the GAAP earnings to understand how the cash actually moves.
Walk me through the mechanics of this, because my alarm bells are still ringing.
All right, USAC is an MLP. By design, they own billions of dollars worth of incredibly heavy steel machinery, compressors, engines, pipelines. Under standard GAAP accounting rules, the IRS requires them to claim massive depreciation expenses on all of that physical equipment every single year.
Right, because machinery rusts, it degrades, it loses value over time.
Yes. That depreciation is recorded as a massive expense on their income statement. It artificially crushes their net income, which is what GAAP defines as earnings.
Got it.
But here is the critical mechanism. Depreciation is a non-cash charge. USAC is not actually writing a check to anyone for depreciation. That money never leaves the company. The actual cash remains safely in their bank accounts.
Ah, okay. The light bulb just went on. So the earnings look terrible on paper because the accounting rules force them to take a massive write-off, but the actual cash coming in the door from their customers is completely fine.
Exactly right. That is why MLPs and their investors ignore GAAP earnings and instead use a metric called distributable cash flow, or DCF.
DCF, right.
DCF measures the actual cash available to be distributed to shareholders after maintenance capital is paid. If you look at USAC's actual cash flow, their normalized distribution coverage ratio at the end of the year was 1.55x.
Meaning they generated 1.55 times the actual physical cash they needed to pay that massive 9.3% dividend.
Correct. And management is projecting a coverage ratio of 1.6x or higher for 2026. So while a 375% GAAP payout ratio looks terrifying, the real-world cash flow easily covers the distribution.
That is a relief.
They are not paying the mortgage with a credit card. They're paying the mortgage with cash from a highly profitable business that just happens to benefit from massive structural tax write-offs.
Okay, my blood pressure is finally coming down. That makes so much more sense. And it is a crucial lesson in understanding the specific mechanics of the sector you're investing in. But there is one more financial risk we need to highlight, and this one feels like a much more direct threat to the stock price.
The shelf registration.
Yeah, I saw an S3 filing from early April registering 18.18 million common units for resale.
That is a structural dynamic that investors must monitor. An S3 filing is a shelf registration. It means a current large unit holder has filed the necessary paperwork to sell those shares on the open market at some point in the future.
Just waiting to pull the trigger.
Right. And to contextualize the scale, 18.18 million units represents roughly 12.5% of USAC's total outstanding shares.
And just to be clear, if those shares are sold, USAC doesn't see a dime of that money, right? It's not a capital raise for the company.
Exactly. The company receives zero proceeds. This is purely a secondary sale by an existing holder taking their chips off the table.
So for an everyday retail investor, that creates what we call an overhang. If you have an institutional seller sitting out there waiting to dump 18 million shares, anytime USAC's stock price tries to run up, that seller is likely going to step in, unload supply, and push the price right back down. It acts like a wet blanket on the stock.
That is the exact psychological and mechanical effect of a stock overhang. It establishes a ceiling on the equity price until those 18 million units are fully absorbed by new buyers in the open market.
Yeah.
However, if we are discussing market stability, we have to mention the ultimate counterweight in USAC's ecosystem, energy transfer.
The massive pipeline conglomerate.
Yes, Energy Transfer is not just a passive investor. They control USAC's general partner interests, and they hold roughly 46 million common units.
Wow.
That equates to about a 32% stake in the company. Energy Transfer operates a staggering 140,000-mile infrastructure network across 44 states. Their deep structural involvement acts as a massive stabilizing anchor for USAC's valuation.
So it's basically having the biggest kid on the playground as your older brother. It signals to the market that one of the undisputed giants in the midstream sector is fully invested in ensuring USAC succeeds.
It absolutely does.
It guarantees USAC is the preferred compression provider for Energy Transfer's massive pipeline network. That definitely offers some peace of mind against the fear of a unit resale overhang.
It provides deep operational and financial stability, mitigating some of the volatility you would typically expect from a smaller, standalone MLP.
Okay, let's pull all of this together because we've covered a massive amount of ground today. On the bull side, USAC is operating with incredible fleet utilization. They are showing real pricing power by pushing their rates to all-time highs. They are investing heavily in telemetry to lower future costs, and they just executed a massive acquisition with JW Power that gives them an in-house manufacturing arm, essentially building a fortress against the severe equipment supply chain bottlenecks causing chaos for everyone else.
The operational strengths are robust, yes.
But on the bear side, you have to accept the friction. They are battling near-term margin compression as they attempt to physically and digitally integrate that massive acquisition. We are seeing major rating agencies and analysts cut near-term earnings estimates, and there is a heavy 18 million unit resale overhang sitting right above the current stock price, creating a ceiling on immediate capital appreciation.
It is the classic tension of a high-yield infrastructure play. You are getting paid handsomely, over 9% a year in cash just to wait. But you have to be comfortable navigating the operational bumps, the margin compression, and the integration headaches along the way.
It requires patience and a deep understanding of the underlying cash flows rather than the headline accounting earnings.
It absolutely does.
Which brings us to the ultimate question. We spent a lot of time talking about how USAC's in-house manufacturing gives them a massive 105,000 horsepower edge, while the rest of the industry waits 2 years for Caterpillar engines.
Right.
It leaves you wondering, if an in-house manufacturing arm is that valuable during a historic macro supply chain crisis, how long until a much larger competitor or a massive private equity firm decides that manufacturing capability is worth buying out entirely? Could USAC themselves become an acquisition target because of the very moat they just built?
That is exactly the kind of secondary consequence investors need to be thinking about.
All right, listeners, what's your take on the future of USAC? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.